Welcome to another edition of the Best Business Minds, where we interview business leaders and academics who write thought-provoking books. I'm Marc Kramer, serial entrepreneur who consults with family businesses and entrepreneurs, and currently I'm teaching entrepreneurship at Vinh University in Hanoi, Vietnam. Today's guest is Marcia Dawood, author of the book Do Good While Doing Well, Invest for Change, Reap Financial Rewards, and Increase Your Happiness. Marcia, welcome.
Thank you. Yes, it's actually Marcia.
Marcia, I'm so sorry. I said that even before we got on. My apologies. Marcia, give us a little background about how you got to where you are professionally before we dive into the book.
Sure. So I was working in education for Kaplan, education for many years, almost 17 years, worked in everything from sales and marketing to operations. I was really one of those people that had a job, moved up in the company, did not leave the company. And one day I was invited to an angel investing meeting and I thought, cool, what's that? I have no idea what angel investing is. So, but I'm intrigued. So I go to the meeting and I come to discover that there are entrepreneurs in every city and every town. At the time I was living in Pittsburgh, Pennsylvania. I lived there for about 25 years. And I got to know a little bit more about the innovations that were happening outside of the corporate world. I used to think that maybe it's the corporations that come up with all the good ideas, but that is absolutely not true. And just had my eyes open to something that I had no idea about.
Did you join the Pittsburgh High Technology Council?
I did not, but Catherine Mott was affiliated with them when I was part of
Yes, I
Blue
know
Tree.
Catherine.
Yes.
I know Catherine because I run the Private Investors Forum in Philadelphia and the Angel Venture Fair, which is one of the largest gathering of angel investors and entrepreneurs in the country.
Yes, I've
So,
been
yeah.
to that several times actually in
Oh,
Philadelphia.
awesome.
Yeah.
Well, I'm glad, and I'm glad to have you on today. So tell us, why did you write this book?
So I learned about angel investing in 2012 and I had started to talk to people about it. And I would say, hey, I'm learning about this company, or I learned about this really cool innovation that people are working on. And I would talk to friends, family, neighbors, whatever, and they would say, wow, that is really cool. Um, that's what, tell me more about it. But then I would say, well, it's something that you could do too. And they would say, oh, no, not me. I can't do that because it's for people who are rich and well connected. I thought you had to have a finance degree, all these things that were out there. And I thought, you know what? I think we have a problem where it's more accessible. I mean, it's definitely more accessible today than it was in 2012. But even in 2012, it was more accessible than it was, let's say, in the 90s. So I wanted to like demystify this and say, I think if we have an awareness problem, how can we actually get more people to know about it? So I started a podcast in 2021 called The Angel Next Door, where I just interviewed people who were already angel investors. So there's a lot of podcasts out there about entrepreneurship and how you build a business or how you raise money and all those types of things. I wanted to know, like, why are you becoming an angel investor? Like, where'd you get the money? Like, why are you doing it? And how do you find people? All those things. So I would ask all the questions. And since then, I'm up to about 150 episodes. And the podcast has kind of morphed into more of like, how can we demystify the entire way that we invest, the way that we use our money for good, the way that we align our values. And so then in 2022, I spoke at TEDx Charlotte and I talked a little bit more about demystifying the whole angel investing space and how you can help these early stage companies. And people said, wow, that's great. But you just told us that like in 11 minutes and that's not enough. So now what? And so here we are. I wrote a book called Do Good While Doing Well, basically outlining all of those things.
Well, Marcia, a question from the audience. Apparently, you just mentioned about a podcast.
Yes. So the podcast is called The Angel Next Door. And if you think about the book, The Millionaire Next Door, if you ever heard of that, from back in probably the 90s, I think that came out. It was all about how people can be wealthy and they may live right next door to you. And maybe they are doing things with their money like, saving or investing, but they aren't necessarily very flashy about it. So that's a little bit where the concept of the Angel Next Door podcast came from. We might not even know that there are people right in our own backyard that are investing in innovation and the changes that we want to see in the world.
Um, In chapter one, you talk about put your money where your heart is. How did your early experiences with Becky and Avon shape your understanding of purpose and driven work? And explain who those folks are.
Sure. So I got really lucky. I got exposed to kind of entrepreneurship at a very early age. I didn't think I could name it back then. I was probably about 14 years old, and Becky was one of my mom's best friends, and she was also our local Avon lady. And one day, my mom asked me if I would help her. So of course I was like, sure, I'll help her. Again, I'm only like 14 years old, and I might be able to like earn some money that I can go buy something at the, candy store, grocery store, whatever. And so she needed me to help her deliver the Avon books and the deliveries of the products to her customers because she did that door to door. Little did I know until my mom explained to me that Becky had multiple sclerosis. And so she had a hard time walking long distances. So what we would do is we would get in the car, we would drive around, and I would get out of the car and run to every doorstep to drop everything off. And, that was really my first exposure to real entrepreneurship. So if you think about it, people who were selling Avon back then and even today are entrepreneurs in their own right. And so I got a bit of an exposure to that. And I really liked the fact that not only was I doing something that could earn me some money, but I was doing something that was helping someone with a disability. And we were able to, create something great.
No question. I think they are entrepreneurs. It's just like franchisees, but some of them
Exactly.
grow very big organizations and have scaled those Avon businesses all
Yeah.
around the world. What role did your father's graduation gift play in your long-term vision for impact?
Yeah. So when I graduated from high school, my dad gave me a magnet and it had a quote from Mahatma Gandhi that said, "Be the change you want to see in the world." And I remember seeing that, and even at that young age, thinking, wow, like I could make a difference. Like I could be the change that I really want to see in the world. And I never really forgot that. And I always kept thinking to myself, yeah, I want to be the change. And, maybe I'd even get a little excited about it. But then I would think, wait a minute. How do I do that? Like I'm only one person. So how do I do that? And then when I learned about angel investing and being able to help entrepreneurs in various ways, I thought, maybe this is that way.
Did your first exposure of angel investing shift your mindset about who can be an investor? Because you mentioned in the beginning, people thought that you had to be ultra rich in
Hmm.
order to be an investor or come from the finance world.
That's exactly right. And you know what? I think even today that myth does still exist. I still talk to people who think because Shark Tank has gotten a lot of popularity and it has done a lot to kind of explain to people like a little bit about what angel investing is. It's not really the reality of it. We don't make decisions in 3 minutes or, just start spouting out, oh, we'll give you this much money or that much money. That isn't really the reality. It is part of television. But when it comes to, how do we change our mindset about who can be an investor, we're talking about the fact that there are people who can invest in what we call at an accredited investor level. An accredited investor is simply a term that we use in order to determine the income or wealth of somebody to see if they hit that definition so that they can become an investor at an earliest of stages. But there are other ways now that even people who don't hit that definition can help entrepreneurs by investing and either funding them or helping them with more than just money.
Yeah, I never understood if you can go and buy stocks in the public markets and they can't be any more trusted. And in fact, you have less influence over their success than you would ever have over your angel investment, where you can actually help with sales and so forth. I don't see the problem with it.
Yeah, I don't either. And you know what? The other thing that bugs me is like, why are people allowed to go buy lottery tickets and gamble at a certain level, but they're not allowed to invest in an early stage company unless they have a certain amount of income or wealth? Well, they should have that certain level of income or wealth to gamble. I don't know. Like, if we really want to protect protect people, then we should probably have more at stake.
Yeah, I agree with you. Can you walk us through how equity crowdfunding democratized access to early stage investing?
Yeah, so people might have heard of things like Indiegogo or Kickstarter. That's rewards-based crowdfunding. Then there's something like GoFundMe, which is a donation-based crowdfunding. And then when the Jobs Act came out in 2012, by 2016, the SEC had put in place something that was proposed in that bill, which said that we wanted to be able to use equity to be able to crowdfund so that a company could say, hey, I'm going to go raise from my neighbors, my friends, my family, but they don't have like thousands of dollars to put in. Maybe they have like $100 or something like that. And so now they could, a founder could do that and they could exchange some equity in their company for that fundraise. So what ended up happening in 2016, once the SEC had all the rules kind of worked out in compliance, there were platforms that put basically a way together for people to be able to do this. Now, as of today, where here we are 9 years later, there are three major players in the space, and that would be WeFunder, Republic, and Start Engine. They're the biggest ones that have the biggest market share. But what you can do is you can simply go on to those platforms and you don't even have to invest anything, which is what I love. You can just look around, you can learn about companies, you can see the types of innovations that are being worked on out there. And I mean, I just think it's really a neat way to learn. And I think it's also a great dinner table conversation for your kids because you can start to talk about like, well, what do you like about this? Or what types of companies are doing things that are really neat and innovative in the world and really get the younger and younger generations exposed to this type of investing.
Well, I think that's Shark Tank has done a good job with that. Their Shark Tank is literally all over the world.
Hmm.
Every one of the Southeast Asian countries has a Shark Tank show themselves, which I thought it was just America had Shark Tank, but literally almost every country has Shark Tank, and people just
Nice.
eat it up. And
Yes.
they become they're major celebrities in Thailand, Philippines, everywhere. These folks are have really helped raise the awareness. What are some common myths about angel investing you'd like to debunk besides being ultra wealthy?
I think the idea that it's so overwhelming and you have to do it by yourself, maybe that you have to have a finance degree. In a lot of cases, when investments are being made by angels, they do it in groups. And the reason being that they can write smaller checks, pool it together, and be able to still help a company quite significantly. But also the diligence that goes on to try to see, is this really the company that we want to invest in? Are we sure that they have the right customers, the right model? Do they have enough money? What are they going to need in order to be successful down the road? All of those things have to kind of play out in order to be able to say yes to the deal. And that isn't something that one person really has the bandwidth to be able to do, not just from a time perspective, but also from an expertise perspective. So I love collaborating with other people and pooling not just our capital, but our expertise to see if it's really a company that we want to back.
Yeah. Are there certain types of entrepreneurs what's the profile of the entrepreneur you like to invest in?
Well, I tend to invest in the underrepresented founder, women, people of color, people who are working on things that really help the communities that aren't being served as much. But when you're talking about, the qualifications or the qualities that you really look for in a founder, I think one thing is in the founder themselves, you want that tenacity level. You want to be able to see somebody who's very hungry. They really, really believe in what they're working on. And in a lot of cases, that means that they came up with the idea or they're working on something that they are personally very passionate about because something happened to them, such as, someone had an illness, if it's a healthcare company, or they had some kind of a problem with something. So they invented, yada padada in order to be able to fix it. So there's that. And then the other piece is about the team. So the other founders, if there's co-founders or the other team members that kind of surround the main founder I think that's super important because you don't want a whole bunch of people that have the same kind of skill set or the same kind of personalities. So really getting to know not just the founder, but the whole team. And then you can make a better decision to say, like, is this the well-rounded team with the level of expertise that can really take this company all the way?
In chapter 3, Hidden Treasures of Investing in Startups, you outlined 5 intrinsic rewards. Can you share a personal story tied to one of these?
Sure. So I'll go with the networking one, which is that, and by the way, the five are job creation, networking, personal growth, first look, and pay it forward. And so my husband is a big golfer, and we have had, well, let's just call it several discussions about how long it takes to play a round of golf, or in his case, sometimes 3 or 4 rounds of golf in a week. So I'm still of the mindset of like, why can't golf take the same amount of time as a yoga class? But that's not beside the point. That's beside the point. So, but what I was realizing is he would come home and he'd tell me about, who he played with or who he got to meet and things like that. And after a while, I thought to myself, you know what? I have lots to do. I don't really mind that he's out playing golf. I'm kind of jealous that he gets to meet these people. And like, how come I don't get to meet like, I can meet people, but I'm not like a huge fan of like the cocktail party networking type thing or anything like that for various reasons. But like a lot of times you don't have something that you can really like in common that you're talking about. So like with golf, you're playing a game for 5 hours or whatever it is, right? 4 or 5 hours. So
Yeah.
you have something in common with that person. What I love about angel investing is I get to meet people, and I get to meet people that I would have never normally met. They have all different types of backgrounds. We have all different types of expertise that we're bringing together. But we are also focused on something that we can have a really meaningful conversation about and kind of get to know each other through that, not necessarily just saying, like, what do you do? What do you do? That kind of thing.
How does job creation through angel investing ripple into the broader economic impact?
Well, okay. So job creation is really one of my favorites. I love the fact that startup companies and angels can help those startup companies to be able to create more jobs. But if you think about, like, just give one example of like how it really resonates through our economy is a lot of startup companies, they're basically starting up by definition. They're small companies that are at their beginning stages. And in many of those cases, they need not necessarily to hire full time employees. They do a lot of contracting work, let's say legal, accounting, even human resources, all of these things. Well, those people who are also part of the community, whether it's the local, regional, or even national community, those people then benefit from the startup's growth because they get more business. And then that means that they have a bigger business themselves. They'll actually end up hiring people. And it provides a lot more for our tax base, both at a local and a national level. So I really think that, job creation is really a wonderful thing. And I think I don't have these exact statistics, but the number of jobs that are actually created from startups is very vast.
How important is it to pick the right angel investor as an entrepreneur? Because we talk about how the angels need to profile the entrepreneurs that they are going to invest in, and there's maybe a formula or and a profile of what they're looking for. But for the entrepreneur, when they're talking to angels, what are the things that you think they should be looking at before deciding to take someone's money?
Oh, yes, that's such a good question. You know, it is so important, this relationship between the entrepreneur and the investor, because when you make a commitment like this, when the investor actually gives the company money or signs up to be an advisor and is giving their time and expertise, it is a long term commitment. This isn't like buying a public stock where you could go on E-Trade, buy the stock, you would have absolutely no interaction with the company at all. And then, literally, like 30 minutes later, if you wanted to sell the stock, you could do that. The liquidity here is not happening until the company exits, which sometimes can take 5, 7, 10 years. We can get into the whole economics of that in a couple minutes. But, essentially, that's really something that I think, making sure that that relationship is very solid, because this is somebody that you're going to have to be interacting with for years to come. And I always encourage entrepreneurs, really take a look at the investors that you're talking to and potentially taking money from, and make sure that they align with your values. Make sure that they can bring to the table what it is that you really want to see help your company. Maybe they have a Rolodex that you'd really like to get into, or and you'd like them to make connections for you. But in some cases, I've seen entrepreneurs actually walk away from investors who were ready to write a check because they didn't think it aligned with their own values. And I have to applaud that.
Actually, as many entrepreneurs feel, how stupid could they be? They should just taken the money. But I've seen throughout my career that that always ends up backfiring on you. That if
I
you're not
agree.
aligned with your investors, or your gut is telling you they're not the right people, you should walk away, even if it's going to preclude you from moving forward with your venture, because it's only going to be more drama and heartache down the road. Better to not do that at all. So I think it's very sound advice. In chapter 4, understanding the process of investing in a startup, what was your biggest aha moment during your first angel group meeting?
So I remember the very first meeting so well because like I said earlier, I'd been working in corporate America, and I went to this meeting and having no idea what early stage investing was. Angel, I've never heard of it before. And I'm living in Pittsburgh at the time, so I'm not in California or New York. And I'm thinking, I really don't know what this is about. But as soon as I hear the entrepreneurs talking about what they're working on, I'm blown away, fascinated. Like, and I'm thinking to myself, I think I've been living under a rock. Like, where have I been? This is really cool. And I just didn't realize how much innovation was coming out of universities, how much innovation is happening like in between the coasts and what happens in the middle of the country. So it was really interesting to see the things that they were working on, and that those innovations are really coming up through smaller companies, and maybe not as much through big corporations like we might think.
How do angel investors evaluate whether a startup is truly scalable? I mean, that's what everybody wants. Here in Vietnam, that's one of the things that concerns them, that a lot of the entrepreneurs are happy just being in the national market here, domestic market, and aren't looking beyond it. But if you're an entrepreneur in Singapore or Israel, the market's so small that you're forced to build global scalable models. So can you talk about that a little bit?
Yeah, scalability. How do you know if a company's scalable? That's like the $1 million question, right? So I think one of the things that first angels look for is that addressable market, like you just mentioned. Like, how big is it? And if you are in another country, like for example, I'm a venture partner with Mindshift Capital. We are a global fund investing in the Middle East, Europe, and the US. And so we have companies in the Middle East, for example, that know that their market is not big enough there. So they have to be thinking about going to Europe, and in a lot of cases, the United States. In fact, I talked to somebody who does a lot of investing in Africa, and his line to me was, all roads lead to Delaware. And I thought that was interesting because, in a lot of cases, like even in Europe or Africa, there's different languages. They have like different rules by country, things like that. But in the US, we're pretty standardized. We have the same language, even though we have different states. And, a lot of people incorporate through Delaware, and that is kind of a standard and what people feel comfortable with. So when people are looking at, back to the question about scalability, when you look at the total addressable market, in a lot of cases, that road, not just for legal reasons, but that road can lead back to the United States, because we do typically, depending on what your product is, but we do typically have that scalability. Now, how to determine if the company is actually going to get a part of that market share is a good question. So if I see an entrepreneur that says, oh, well, the total addressable market is X, and we're going to be able to pick up about 30% of that, That to me is like a big red flag because getting 30% of any market is pretty difficult unless it's a very, very, very tiny market and you have something that nobody else, you have like no competition, which never happens. So I really think that it's a matter of, being realistic about the market share that you can take and then making sure that the market's big enough so that when you take that small percent, it is a big number.
One of the audience wants to know, do you still live in Pittsburgh?
I do not. I loved living in Pittsburgh, and my husband pulled me out of there. And between 2010 and 2020, we lived in Pittsburgh, New York, Dallas, San Francisco, and now we live in Charlotte part time and New York part time.
I love Pittsburgh, actually. I went to
I love it.
WVU. It's a very underrated city.
It is.
Yeah, very, very nice. Um, what are the typical investment sizes that angels are investing in? And I hear lots of entrepreneurs, new entrepreneurs, think that when the angel invest, that they're going to take 51% of the company. It's always a big fear.
Yeah. Well, that's crazy. I mean, maybe people do that, but that's not a typical angel investment. And the one thing that I do see entrepreneurs get a little, well, in some cases, a lot upside down on is if they give away too much of the company early on. So an angel investor should be thinking about it in the standpoint of not just this round, but what is the company going to need in the next round and maybe even the next round and maybe even the next round before they get to that exit. Because what you don't want is to have the founder so diluted that they no longer have an incentive to keep building the company. And in many, many cases, and certainly in my case, I do not want to go in and build your company, right? I'm investing in you as the founder, right? So I think it's really important that we're very realistic about what it is that, that we really want to do with that.
Isn't always the investor's worst case scenario? They're one that they're just so afraid, and that is actually getting rid of the founder, because many entrepreneurs feel like, oh, if they invest, they're going to get rid of me. And
Right.
I always tell them that's the nightmare scenario for them.
That's right. That is the last thing we ever want to do is get rid of the founder. In fact, I had a company that we invested in a long time ago, and the founder did leave, and there was another CEO brought in, and actually one of the investors stepped in as the CEO, but it was not by choice, and it was, at first a very rocky situation. It's not good.
So, what are some of the things that angels can do for you along with providing the money? I mean, you talked a little bit earlier about some of the things that you should profile, but what should be your realistic expectation? Because I've seen angels who do very little and just give them advice about things. And in the West Coast, I've seen the PayPal mafia, where they actually pick up the phone and they call people and open doors and speed up the process of success.
Yes, and everything in between, right?
Yeah.
So, I think expertise is a big one. And that could be in the form of advice. It could also be in the form of helping to hire the right people. So instead of necessarily the advisor or the investor is going to tell you what to do, they might be able to actually lend their expertise to make sure that the person that you need in order to work in your company is actually the right person. So I love when that type of interaction can happen. Definitely people being able to just pick up the phone, make a phone call, and make an introduction can be so incredibly valuable to the company. And I think in a lot of cases, investors sometimes discount how valuable that could be. They think, well, I want to be able to help the company, but I don't have a lot of time. Well, literally, I mean, it could take you 2 minutes to write an email to introduce the founder to somebody that you know. And I'll give you an example. In one case, one company that I'm invested in, they had a real problem with advertisement because the company is a women's health product and they were being labeled as pornographic, even though it had absolutely nothing to do with pornography. It had to do with pelvic floor health. And so Facebook was actually banning their ads. And it was a huge problem. They were doing great. Women were finding out about it. They were getting the help that they needed. And then all of a sudden, the whole pipeline just kind of dried up because they were no longer able to run these advertisements. And then finally, somebody, one of the investors, picked up the phone, called somebody they knew who was relatively high up at Facebook, and got the situation changed. And I believe started to help get some of the algorithms rewritten because that is where the problem really was.
When you have a board of directors, especially a lot of them are going to be angel investors representing the angel groups that you're interacting with, uh, how trusting should the entrepreneur be in terms of like when things aren't going well? Should they confide in their angel investors and tell them, "Hey, things aren't going well right now. Can you help me solve it?" Or will they look weak? And what kind of information should they be providing their angel investors on a monthly basis?
Right. So this is so important. And I think this is really set at the beginning of the relationship once the decision has been made for the investment to be made. And that is setting the expectations of what's going to happen moving forward. So I always ask any entrepreneur that I invest in or any of the funds that I've worked with, we ask that they give us at a minimum a quarterly report. Now, sometimes a monthly report can get a little laborious for them, but even just to have like a monthly email that says what happened, I mean, it could take them, 5 minutes to write it, would be great. But I can barely get people to give me a quarterly report, so I don't know that I could actually get them to give me a monthly report. But it is very important that the investors are kept in the know. What I absolutely hate as an investor is finding out that the company is struggling and they've been keeping it a secret because, like you just mentioned, they are afraid. They don't want to tell us. They think it's like bad news and we're going to get mad. No, we want to help. So we can't help though when it's too late. And usually the entrepreneur's telling us when it's too late. So I would much rather know about it so that we can try to head it off before there's a problem. And that's where you really get the investors to really rally behind the company. And one of the things I think angels could probably be a little better at, and I talk a little bit about it in the book, but I really try to show it a little bit more with people that I'm either mentoring or talking to in different angel groups or angel funds, and that is follow-on funding. So sometimes angels will, they'll really like a company and then they won't hear from the company for a while, and then they'll be on to another company. And then that original company will come back and say, hey, you know what? We're not really doing that well. Or, hey, we hit some milestones and now we're raising another round. But if I haven't heard from that entrepreneur for a while, or if any of the investors hadn't, and all of a sudden the only time that they're asking for anything is when they're asking for more money, that's not good either. So, that consistency of giving updates, whether they're good, bad, or indifferent or ugly, is super important.
So here I'm always asked this, what's the due diligence process look like? And how much are an angel investors typically investing in these early stage companies? And now they're not even seed stage because even angels are looking for show me that somebody is eating the dog food before they invest. So
That's true.
what's that process look like now? The due diligence process, how long does it take? What kind of questions do you ask? And what are what's the average size check that angels are writing today in 2025?
Wow. Okay, that's a lot. So let's unpack that. So the diligence process can take anywhere from 5 minutes to 5 months to 5 years. And I say it like that because in some cases, if somebody's investing on their own, maybe they're not part of a group or a fund, they may just like the founder and say, I'm going to invest in you because I like you and I'm willing to take a risk. Typically, I would say it's more like 5 months, anywhere from 3 to 5 months to be able for an angel group or an angel fund to really get comfortable with what the company's doing, the team, the market that they're addressing, who's the competition, is this a scalable company? All the things that we've been talking about. But I will give you an example. There was a company that, after knowing the founder for 5 years, we ended up finally making an investment in the company because we really liked what the founder was doing, but it wasn't really at a point where it was investable yet. So, those are kind of the typical things that happen in a diligence process. I'm super cognizant of the fact that entrepreneurs have very, very little time. So I'm always careful, especially in a group or a fund, that there's one point person that asks the questions to the entrepreneur, and not have like 4 or 5 different people from the same group or the same fund asking all these different questions. And then the entrepreneur's like, wait a minute, somebody else from your group just asked me the same question, or they just asked me 3 other questions, and you asked me this. It's all piecemeal. And it's like, it's total waste of time for the entrepreneur. So I think it's important, yes, that the entrepreneur give the type of information that's being asked of them. But I think we as investors need to be very respectful of the entrepreneur's time and make sure that that is all done in a good way, so that we're not wasting our time and we're not wasting their time. And when we are ready to say no, which sometimes we're ready to say no pretty quickly, let's get to that no, and let's let the entrepreneur and let the angel group or fund or whatever move on. Because sometimes I see this get dragged out and dragged out. And then the entrepreneur's like, okay, well, they just won't give me an answer. They won't say yes and they won't say no. And then that goes on and on and on and on and on. And that's not good for anybody.
Yeah, I mean, I raised money for 3 of my ventures, and they were all corporate strategic investments. And one was as little as 3 months, one was 2 years, and another one. And I knew this person, I had lunch with them every week, and it took 9 months to get the deal done.
I believe it.
So, like you say, it ranges all over the place for that. And today, investors are putting all the money in at one shot. They're no longer doing in tranches where you have to make certain milestones. That's my understanding from talking to people in Silicon Valley about the venture world. Does that hold true for angels as well?
I never was a big fan of the tranching model with angels. I didn't do it a whole lot, but we did do it a couple times. And what I find is that if you are asking a company to be very, very focused on one specific milestone or 1 or 2 specific milestones in order to be able to get the money that they're promised, let's say that, you know, back to your question for 1 second about the check sizes. An angel group will typically put in 100 to 250, maybe as the averages, sometimes up to 500,000. But if they're waiting, let's use that as an example, 500,000, and let's say that the startup was given, let's say, 250 to start, and they're not going to get the other 250 until they hit these milestones. Sometimes that can actually hinder the business. I saw a company once where they were so focused on the milestones that they kind of missed the bigger picture of what else could be helping the company to grow. And startups need to be nimble, and they need to be able to pivot, and they need to be able to really think outside of the box and not be beholden to, very, very strict metrics that will then unlock more money, because that's what they're going to drive to. I'd rather see them um, working toward milestones that will then get the next round of funding to come in, like will attract the bigger investors, as opposed to saying you can't have this money unless you do this.
Uh, Question from the audience. Angel investors often play a pivotal role in funding early stage biotechnology, where long timelines, high risk, and regulatory hurdles can slow traditional venture interest. From your experience, what signals or strategies should biotech companies do, especially when it comes to dealing with angel investors? And should they care and have a deep technical background, but care about both impact and returns?
Yeah, this is a great question. Biotech is one of those industries it's tough. It takes a lot of money and a lot of patient money. So finding those investors who are regular biotech investors who really understand that, I think, is super important. Otherwise, you end up with investors who they might really think, oh, I love this because it's like solving this great problem and it's going to help people medically and, physically and all that kind of stuff. But they might not have the patience to be able to actually, you know, not only help the company grow, but they might not also be able to follow on or help them get other investors down the road. So I'm always cautious that in an area like biotech or climate tech, where we're talking about, big dollars and long time horizons, be careful that you're getting, in with the right investing crowd.
Yeah, we used to have quite a few people who came from the pharmaceutical industry who were
Hmm.
very savvy about that and understand the patience
Yes.
required to make that investment. But unless you're an expert in that area, that's an area you definitely want to stay away from as an
Yes.
investor. In chapter
Agree.
5, dissecting the disparity, why do women get less than 3%? And is that still holding true? Like here in Vietnam, 62% of the CEOs are women.
Nice.
And it's probably the only country in the world that's like that. Vingroup, the biggest company in Vietnam, all 16 CEOs of all 16 companies are all women.
Nice.
So
Um,
is this still holding true in the US
I think it
or around
holds
the world?
true. I think it holds true the higher up you go in the companies that are raising like Series B, C, those types of things. At angel level, the Angel Capital Association has put out quite a bit of data. We have an angel funders report. The latest one actually just came out very recently. So if you go to the angelcapitalassociation.org, you can find the latest report. But we typically find that about 25 to 30% of investors are women. And the amount of capital that's going to the founders has definitely, we've seen it more in line with that. When you get to the bigger stages, the bigger stage companies and those bigger stage funding rounds, then you're seeing less and less. But the statistic of like 2 to 3% has been thrown around for a really long time. At the lower end, at the angel end, I think it's getting better. The thing that will help improve that is people will tend to invest in people that look like them. So we need to get more women to become investors, and then we will see more women actually get the funding as
I
founders.
I ran a program for over a decade that still runs called Women Founders and Funders. And a lot of the women CEOs who were on the panel said it was easier for them to raise money from male investors than it was from female investors. And they said
I
that
believe
they
it.
felt a lot of the female investors were more risk adverse than the guys were. So in the beginning, it was hard to get guys because they just didn't understand what they were, the kinds of companies they were starting. But she said once they understood, they were willing to take the risk. So what's your take on that?
That's pretty much the whole reason I wrote this book. I think that women tend to be risk astute, in some cases, even risk unpracticed. I don't know that risk averse is maybe, the best way to explain it. I think what women are trying to do is make sure that they have all the information to make an informed decision. And in a lot of cases, we just have not as a gender been socialized to think about investing the way that men think about investing. And so that's one of the things that I think is something we need to really keep talking about. This isn't something that's going to change overnight. So I can see where the founder that you're talking about actually did say it was easier to fundraise from men. We need to make sure that women are being invited to the room in order to look at different investment vehicles and how they can invest in them. But B, really have them be a part of the conversation overall about our economy, the innovation that we want to see in the world, and the things that will help propel the changes that they care about and how they're going to align their money with their values. So, this is a conversation we're going to need to keep having. And I think when it comes to risk, it's more about education than saying, "Oh, I think that's too risky and I'm not going to do it." I don't fundamentally believe that every woman believes that. I think they just feel like they don't have enough information yet.
What does storytelling like show her the money play in driving systemic change?
Right. So you mentioned it earlier, Shark Tank is everywhere. And, television media, these are the ways that we can really make change, where we can get people to take a look and say, hey, I do like the fact that, I could help this company, or I could get to be a part of, a cure for some type of a disease, or help with a treatment for, let's say, Parkinson's, or my mother passed away, unfortunately, from ALS. Those are things that really need some help and some treatment. So yeah, we need to be able to do all that and help these companies to to grow and scale. But those are the things that I think we really need to really hone in and focus on what it is that we care about and align with that.
Question from the audience. Do you have any input on whether we should accept or decline a share subscription facility, SSF, prior to our IPO? I'd appreciate your thoughts on any potential benefits or drawbacks you see at this stage. And you probably need to explain that to the audience, because some of them are college students listening.
Okay, well, that's a little bit above my pay grade because I'm not sure what an SSF is.
I had not heard of a share subscription facility before.
Yeah, I don't know. Maybe Michael, you want to come off mute and just tell
Yes,
us?
yes. Hi, I'm sorry I'm late. Um, we have got a agreement that they want us to sign. This is a big company, a multi-billion-dollar fund. What they do is they give you 50, in our case was 50 million worth of facility. This is the way it works. We have to meet their terms and conditions and sign the agreement. When we have our IPOs, they pledge to purchase our shares under certain terms up to $50 million. And I have been negotiating with them for 4 or 5 months now. I still have a little bit of reservation. Why? It's almost like they could lock us up because there are terms in that agreement that potentially could be adverse to us. So why would a company come to us and really entertain us for so long? I've run them around a lot, to be frank. But they seem to be still steadfast to try to get me to sign something. They are willing to negotiate. We have negotiated some terms. But as a general rule, have you heard of or seen anybody that have used these facilities? I know Mark. I've seen Mark before, but when he was in the US, he probably, have you heard anything, Mark, about these?
I have not. And do you have a good venture attorney who's done deals
Yeah, I
in
was just gonna
this type of deal? Because I think that I have some concerns hearing what you're telling me now, that you could be significantly diluted from this kind of agreement. It seems more predatory to me than something that's going to be good for you overall. So, do you have a really experienced venture attorney
Oh,
who's
yeah, they have.
familiar with this kind of agreement?
Yeah, they have looked. They want me to sign it. I have problems. I want to make sure.
But your attorney is not a typical business attorney. They are a venture experienced attorney. There's a big difference from that. So are these people who do deals with venture funds all the time?
Yeah, oh yeah, it's you know him. It's Greg Novak's firm. So
Uh-huh.
I mean, he passed away, but it's his firm. The key is I have to make a decision. What good does it do me today before IPO to sign this agreement? I have a hard time with that. The second part is what this company really wants, because they are insisting on us signing now when our Crunchbase ratings are going up. So what's their motivation? They get 10% discount on the price. I can see that.
Right.
But
Yes.
why would the CEO agree to it? I guess that the question is, how do we benefit from such offer? It's a great offer. I mean, believe me, it's not every day that somebody offers me 50 million bucks. It's not every day. However, I'm hesitant, and I just wanted to see the discussions. By the way, I'm so glad this is a real Zoom call. I thought this is a broadcast. That's why I wasn't quick to join. But if it's a real Zoom call, then you're real. I know you. I should have known that now you are doing a new venture, Mark. Um, but anyhow, if you have experience with it, I would appreciate it. If you don't, that's fine too.
Yeah, I have not had experience with this myself. I mean, I got big corporate investments and there's had lots of stipulations and so forth and how much money they'd invest. Marcia, do you have any other thoughts on it before we move on? Because we have other questions from the audience.
Yeah. Somebody in the chat said something about, talk to an investment banker too. So that's another option for you.
Yeah.
Yeah, I would definitely say that. If you could, Michael, if you can mute again, that would be awesome. So I can go, but thank you for sharing that with us. Another question from the audience. How do you develop an entrepreneurship mindset and attitude as a college student without having a background in business?
Well, there's a couple things. I mean, definitely there are plenty of venture firms, of startups out there that are looking for interns. So while you're in college, you could do maybe a 10-hour-a-week internship, or over a summer, you could work for one of them. I know we do that at Mindshift Capital every summer. We have interns that come and help us and they can learn that way. With my book, I do actually have a workbook where one of the exercises in the workbook, one of my personal favorites anyway, is to go and make your own mock portfolio using Play Money by going on to some of these equity crowdfunding sites and learning about the different companies that are fundraising and a little bit more about what they're doing, what type of team they have. And I think just exposure to all of that and really seeing the way that that's set up. What I love about the equity crowdfunding platforms that are out there, and we mentioned a couple of the big guys earlier, but they tend to have everything kind of set up in the same way. So you can see different companies, but with the same type basic information, because the SEC has made it so by compliance rules, they have to be able to disclose, all of these different things about their team and their market, what they're doing, all that good stuff.
Yeah, it's a private placement memorandum, and they have to basically have to get all of that information out there. In chapter 6, you talk about unpacking your toolbox. Entrepreneurs need more than money. What are some of the overlooked ways non-financial support can transform a startup trajectory beyond opening the doors for helping them with sales?
Yeah, I mean, I think a lot of the things that we've been talking about, like just the expertise of like hiring. How do you get more people to really know about the company? Even having the investors become customers, that's really helpful. And you'd be surprised, just liking social media posts, reposting it. It really does help to drive, especially if there's a customer base that the company is trying to build up.
What's the most unexpected skill you've seen make a huge impact on a startup?
Well, I think the thing that's most unexpected is that people don't realize how many skills it takes to build a company. It's really hard. It's really hard to build a company, and you need all the skills. And so in a lot of cases, I think a lot of these companies are really looking to hire the right people. They want to be able to make sure that they're using the right contractors. So all skills are good skills. Sometimes people say to me, well, I couldn't help a startup company because I don't have any skills to offer them. And I'm like, geez, you sure do. Like you have lots of skills. So it's just anything, even being like whatever you want to call it, like an armchair therapist, because sometimes entrepreneurs, man, they got a tough job. We got to help them in a lot of ways.
Yeah, you're right. They need like a psychologist to sit there and listen
They need a
to all of
cheerleader.
these. Yeah, right. And remind them why they're good.
Yep.
because they, especially when things aren't going well and they lose their confidence and you have to rebuild them up. How can a donor advised funds, DAFs, be leveraged for early stage investing?
Yeah, we could do like a whole episode on this. So, donor advised funds, I'll just make it short, is where you use philanthropic money. Basically, people can put money into a donor advised fund to get their tax deduction immediately. In a lot of cases, donor advised funds are used when somebody has a big bonus. Maybe they sell their company. They want to be able to make, be able to get a big charitable deduction on their tax return, but they don't necessarily want to grant out that money to charities yet. So it sits in like a donor advised fund. So think about almost like an IRA, because IRAs can be used also to invest in angel companies or startups. So in this case, there is an account, in this case, a donor advised fund. And that money can never, as it grows, and in a lot of cases, if you were at like Fidelity Charitable or something like that, they might put the money into public stocks. And as the company grows or mutual funds or whatever, it can never go back to you as the donor, but it will grow and potentially lead to more money that you can donate to charity later. Well, you can do the same thing by taking that donor advised fund money and putting it into startups. You do need to do it through a group that actually does, I call it self-directed investment. Like Fidelity Charitable is just going to have whatever's on their platform. But something like Impact Assets will actually allow you to have your donor advised fund money then invested into a for-profit company.
What's the potential of revenue-based financing and reshaping access to capital?
I think revenue-based financing is definitely an up-and-coming thing. We're going to see, I predict that we're going to see a lot more funds coming up, especially at the angel level, because revenue-based financing is where investors can make an investment into a company, and instead of getting equity, what they get is they get a dividend, essentially based on the amount of revenue that they have that month. So it's a little bit like a loan, but it's not a set loan payment amount like you would normally see with a loan. It's more based on the revenue that they have that month. Because sometimes in startup land, it can be very cyclical, be seasonal. So in this case, it can actually help the companies to be able to make the payback better. But angels are really liking it because they will start to get money back sooner and they're not having to wait that huge timeline.
What crowdfunding we've been talking about before, VCs often have concerns about the cap table. How has that been working? Because I understand some of them, they group them all together so you don't have all these individuals.
Yeah.
Has that been worked out where crowdfunding is now more acceptable to angel groups and VCs?
Yes, in fact, very much so, to the point where some VCs are actually encouraging companies that they're talking to before they'll make an investment to have them go do an equity crowdfunding round. So, and to your point, it does all get pooled together. So there's only one line on the cap table, and the cap table line is like, let's say WeFunder or whatever it is that they're using. And then WeFunder manages the investors, not the startup.
So my last question is, what are angels investing in? Like what industries are they focused on? We know AI is very hot. I worked with Antler in July and sat through 68 presentations, all using AI in some way because they feel like that's the buzzword. Just like every time we turn around,
Yes.
Crypto, whatever it is, they want to use what the hot word is. So what are angels focused on right now, or what aren't they investing in? So don't bother, picking up the phone and calling them if you're doing this. There's just not a lot of interest in whatever that is.
Yeah, well, we could have a whole other conversation on that too. But the definitely AI, healthcare is never going to go away. We love healthcare. We need to have innovation in that space. What I will say is that it's been a really, really rocky last 3 years. So in 2020 and 2021, there were a lot of exits. The M&A market was strong. People were deploying capital. They were making investments. It was a heyday. It was great. I personally had several investments in 2020. It was lovely. I dream about it again. Okay. But then in 2022, it started to dry up. And the last 3 years, we've really, really struggled to get the M&A market to come back. And I was hopeful that beginning 2025, that we might see that happen. Unfortunately, it's just been a little bit slower. But I was talking to an M&A attorney yesterday, and who told me that I should have faith, and that the M&A market will start to come back. Now, I say all that because once I think we start to see the M&A market come back, you will start to see that angels will start to invest in more things that are maybe not so focused on AI. I mean, and they're still going to be focused on AI, don't get me wrong, but they're going to start to invest in a lot of other things because the liquidity is flowing more. Like right now, I think we all feel poor because we don't have that liquidity. And if we can just get to that liquidity point again, where we're getting some of that, and we can recycle that back into the entrepreneurial ecosystem, then we're going to be better off.
Yeah, I for the first time in 28 years, the Angel Venture Fair is not taking place this year in 2025 because angel groups have suggested to us push it off to 2026 because the lack of investment that's happening, that they're also waiting to make investments until the market improves. And that's
right.
Unbelievable. Even during the pandemic, even during the crash of 2008, we were still running this and getting good results. But when you're hearing from angel investors that the different angel groups, hey, we'd really prefer you not to run it this year and just push it off to 2026, that's pretty scary for entrepreneurs as a group.
Yeah.
Well, I want to say the time went too fast, and
did.
I
Went
really
very
enjoyed
fast.
your book. And I thank you so much for taking the time to talk to us about your book and answer questions about angel investing and why people should get involved in this and the importance of it. So thanks to everybody for coming on and listening today. And Michael, thanks for sharing. And so I look forward to hopefully seeing you all next week. Have a good rest of your day.
Thanks, Mark.